We're going to be talking about charitable gifting and how it impacts us as tax preparers, or for some of you, but most of you for the purpose of financial planning advice. So let's go from there. Our objectives will be identify qualified charitable entities, describe deduction limitations, describe the carryover period, discuss partial interest gifts to charity, identify non-deductible contributions, identify substantial requirements, and describe the charitable contributions by business entities. I might note before we get started that I've heard from many people in the charitable area that charities are like insurance. It's got to be sold by the planner or the tax preparer. It's not something people voluntarily do. Yes, there are some people who are very charitable minded, but typically it's up to the preparer to get people to think about social responsibilities. Today in business world, there's big emphasis on the social responsibility of businesses. I think there's also realized that by most of our clients that they have a social responsibility, and that's charitable. I'm one of those who believe that private charities do a much better job of helping than government funds, which have a lot of strings attached to them. So what is a charitable deduction? It's an itemized deduction from the income tax of the federal government. State governments have different rules. It's one of the IRS code 502c3s, not-for-profit, that can receive a tax deduction. A lot of 503c3s do not pay taxes, but you can't not make contributions to them. These are the ones you can. Must be a qualified charity recognized by the IRS, and the IRS publishes a list of qualified charities, which is available to everyone. And there's Charity Watch, and a number of other sites on the internet that give you a lot of details about all of the charities as to how much they spend, where they spend it, and how much actually goes to the charitable causes, which surprised a lot of people. A lot of people say, give the charity, all of it goes to whatever, and that is not true. And there's also many of the charities you're going to run into are not qualified. In fact, majority of the charities you run into are not qualified. So they have to be due diligence to find those that are qualified. And if you give to a public charity or a private foundation, there's different tax consequences. Valuation are generally valued at fair market value at the time of transfer. However, there are bargain gifts where you get something in exchange. For example, if I want a USC ticket, I give $5,000 to the school, and USC gives me a $300 ticket. Well, that's a gift and a bargain gift. And being a bargain gift, the part that's the $300 ticket is not deductible, and the amount above it would be. If you believe it to be a deductible charity gift, and it isn't, bequests to charities that are not qualified are not going to be tax deductible, and if you have it listed, you're going to get called in and lose the deduction. And unfortunately, majority of what you're going to run into are not qualified, as I mentioned before, and I keep repeating that because so many of my clients over the years have given to the Society for the Protection of Dogs in Ventura County, which are qualified. You have to look them up each time. Value raffle tickets sold by a charity do not qualify as a tax deduction. Your time and services for a charity do not qualify. Use of your residence or beach house for a charitable function doesn't qualify. Political gifts to non-503c entities, even if for political causes that help society, do not qualify. In other words, it's got to be a 503c3, and how do you know? You go to the list that the IRS publishes. Gifts to individuals, such as handicap, don't fall under qualified gifts or requests. Although foundations can, but that's another subject. Paying for education of a non-dependent is not qualified charitable deduction. And I bet you're surprised on a lot of these. We have some more. The ones that most commonly I run into when I do taxes for people. Dues paid to social fraternal organization. They belong to the Moose, the Elk. They take a deduction. It's not deductible. It's not a 503. Foreign organizations, unless qualified by the IRS. I had people deduct money for Irish sweepstake tickets. One of them had like $10,000 she put in, and the Irish sweepstake tickets she didn't win. and she took it as a deduction. The IRS, in an audit, found it. They were auditing her charitable gifting, and it was disallowed. Homeowner association fees, sports clubs. Now, youth organization sports, like youth soccer, which is very big today, Little League, those qualify. Again, look at the 503c3s. Labor unions, associations whose purpose is to lobby for changes in law, are by definition not, and politicians. There's special laws for them. 2 different tax laws cover gifting. There's income tax, which is covered herein, and gift and estate tax, where rules are substantially different, and they're beyond the level of this course. They are very complex and are covered in your estate planning course. Tax benefits of gifting under the income tax law: a donation of $1,000 to a qualified charity or someone in a 25% tax bracket saves up to $250 in taxes, and that certainly is significant. And someone says, well, it's only $250. Well, let's face it, we're sharing. It's like the person who says, I bought a home to save taxes. What tax bracket are you in? 15%. Well, if they're making $1,000 house payments on interest a year, and we'll keep it simple, only $150 of it is going to be tax deductible and paid for the government. 85% of it is not deductible. Same way with lunches. The government picks up half the lunch in a business transaction. You're only going to get 15% if you're in the 15% tax bracket, where it benefits the people in the 39th% bracket, because then the government picks up 39%. And that's the same true with charities. So the higher the tax bracket you're in, the more you benefit. The lower tax bracket, the less of the benefit. And most of your clients don't understand that. If higher tax rate is even better, and I gave the 39%, which is almost a 50% increase. Depreciation of long-term capital assets provide tax deduction at fair market value, plus the client does not pay capital gains. So it's the best bang for the dollar in gifting long-term capital gain assets to a public charity. Private versus public charities. Due diligence requires confirmation that the end of a charity is qualified and its status as either being a public or private charity, and quite honestly, there's a big benefit to private charities for the charity and for the taxpayer. In some cases, private charity can be an answer for the taxpayer, which is covered in other courses, not in this course. The big difference to a donor for income tax purposes, at the maximum percentage of IG, just gross income that we donated in a tax year, if a gift exceeds that cap, it can be carried forward for the next 5 years. So I have had clients who had a big year on income, or they thought they did. They gave the charity a big amount of money, and it turned out it was over the 20, 30, 50 threshold that they have for it. They had to spread it over the next 5 years. And we'll give you examples. These are just examples. The difference, if it's a public charity, cash up to 50% AGI, but if you're a private charity, such as a foundation, it's 30% maximum. Ordinary income property is 50% AGI for the public charity, but for private, it's up to 30% of AGI. And that's the adjusted cost basis. Long-term capital gains property, 50% for cost, adjusted cost basis. For fair market value, it's 30%. So you pick to choose which one is more favorable to you on the long-term capital gains. But if it's a private charity, it's cost only up to 20% of AGI. Whether long-term capital gain property is used herein, property is held for more than 1 year and 1 day actually. To be classified, it must be real and intangible personal property. So that could be real estate and securities are the 2 examples, or it could be tangible personal property such as cars, jewelry, artwork, and these are better tax treatment than non-used related. If it's non-use related, you get a smaller deduction. So you have to find out from the charity whether it's going to be use related or not. Sometimes it's simple. If I'm giving a statue to a museum, that's use related. I give a computer to a museum, obviously not use related. Yes, they use it, but it's not the purpose of the charity. But you can get into some gray areas, such as a used ambulance to a hospital. Is that going to be used by them or not? and that you have to find out from the charity. Carryovers are acceptable. That's the 5 years after. That it's very complex. You got to do a great job with documentation. They're subject to original percentage limits in the carryover years. So if you had some 20% and some 50%, they carry forward. And deductible after deducting allowable contributions for the current year. So if you do a lot of gifting every year, you'll probably lose it. So this works for people who have a big year donation, then the next few years don't, so that they're able to make use of it. And if 2 or more carryovers, the oldest one is used first. And again, I want to create documentation. Is awfully important in this case. I've had several clients over the years who came to me because they were called in on audits. They needed to document what they were doing, and it was impossible to track it from a documentation standpoint, and therefore they lost. Partial interest, as a general rule, are not deductible unless it's qualified, and we've listed the 4 qualified here: lead trust, unit trust, annuity trust, and personal residence trust. Otherwise, if you give a partial interest in something, not tax deductible, even though it went to the Red Cross or the Boy Scouts of America or the Lutheran Church or Cal Lutheran. Now, if you only have a partial interest, such as tenant in common interest, and you give up your share of it, then it is deductible. But you got to give your full share up. And that, again, tends to be rare. People generally say, well, I want to get half to my daughter and half to the Cal Lutheran. Well, not qualified. Even though it went for charitable purposes, it does not meet the statute. Businesses. Generally the same rules as personal income tax return. However, donations to non-qualified organizations may qualify for deductions as ordinary and necessary business expenses. And I'll give you membership at a golf course. Sounds like a good deduction for charity, but it isn't. Therefore, we make it as a business payment if we have a business that we can apply it to. Cap for yearly deduction depends on the business legal type, and it can be as the 20, 30, 50 that we describe for individuals, if it's a sole proprietorship. But the opposite, in the corporation, C corporate would be 10% of profits. Substantiation of gift bequest. Gifts of nominal value, diminished value, are not deductible. Examples would be old or broken furniture, appliances that don't work, used Christmas cards, worthless securities, land in California City valued at $50. These are things that don't qualify as a gift for gift tax purposes. Now, they may be liked by, for example, I know Salvation Army will take this stuff and they'll fix it, but it's not deductible. Proof of giving. Contribution property over $5,000 require qualified appraisal. Fees for the appraisal are a miscellaneous deduction on the tax return. Exceptions public securities, which really don't need appraisal. So one of the things I ran into many times is the client would be giving away $20,000, $30,000 worth of items, but the appraisal fee was another $5,000 or $7,000, which they had to pay as miscellaneous income, which drastically 2% is lost out of your AGI. So they paid a lot of it out of their own pocket for the appraisal, which diluted the amount in their minds as to what they were gifting. But that's the tax law. Artwork valued at $20,000 requires a value determined by the IRS advisory panel, and if over $50,000, I'm sure it should say $500,000, the donor will submit the IRS statement of value and pay a fee of $2,500 for the evaluation. Artwork is tough to value in the first place. It's something that's many times gifted to get it out of the estate, so it's not a problem at the estate tax. Summary. In this lesson you learned about the benefits to donor and charity for gifting, the types of qualified charities, the way to calculate tax savings with both types of charities, and finally your documentation. And again, documentation is so important in this area. I can't say more on the subject.